So you've probably seen the buzz around WPAY, the new Roundhill Weekly Pay ETF, all over social media and finance YouTube. Some investors are hyped, saying it's the next evolution of income-focused ETF. Others, they're calling it a short-lived trend, one that might fade as quickly as it came. So today, we're breaking it all down. Is WPAY a buy, a hold, or time to move on? And more importantly, where does it actually fit in an investor's portfolio? Let's dig in. When WPAY first launched, it caught everyone's attention for one key reason: weekly payouts. Most ETF, even income-focused ones, pay monthly or quarterly dividends. But Roundhill wanted to change that by creating a fund that delivers consistent, frequent income every single week. And naturally, that idea grabbed investors who want cash flow without the long wait. Now, WPAY isn't just a random experiment. It's built around a unique concept, combining exposure to multiple Roundhill covered call ETF that themselves pay out on a weekly schedule. That means WPAY acts like a basket of weekly paying ETF, distributing income to shareholders every week like clockwork. This ETF of ETFs structure makes it stand out in the crowded dividend ETF space. But here's where things get interesting. Even though the idea sounds simple, the mechanics behind WPAY are quite complex. Each ETF it holds uses covered call strategies on high volatility assets, and that income is then passed through to WPAY investors. So, in a way, you're indirectly holding exposure to multiple income-generating funds inside a single product. And that leads to a big question. Is that actually a good thing? Let's talk about what investors love about WPAY first. The most obvious draw is frequency. Weekly income feels different. Seeing those payouts arrive every week gives investors a sense of consistency and reliability, almost like a paycheck. That rhythm can be especially appealing to retirees or to anyone building an income-focused portfolio. Then there's the simplicity factor. Instead of trying to manage multiple weekly paying ETF individually, WPAY wraps them all up into one package that makes it a one-stop shop for people who don't want to track multiple positions or worry about aligning payout dates. And finally, there's momentum. Roundhill has been growing fast in the income ETF space, and with new investors chasing yield and consistency, WPAY has benefited from the hype around weekly income investing. It's become a sort of symbol of where dividend investing might be headed. More flexibility, more frequent payouts, and potentially more predictable income streams. But of course, no ETF is perfect, and WPAY has its share of valid concerns. One of the most discussed topics right now is sustainability. The ETF's underlying holdings rely on covered call strategies, meaning income is generated by selling call options on their respective underlying assets. While that can produce steady income, it also caps potential upside if the market rallies. In other words, WPAY's underlying ETF might earn strong premiums in volatile markets, but when things calm down or move strongly upward, returns could flatten out. Another concern is overlap. Since WPAY invests in multiple Roundhill products, some investors worry there's too much exposure to the same kind of strategy, or even the same underlying assets, repeated across different ETF that could make WPAY less diversified than it appears on the surface. And finally, there's NAV erosion, something income investors have become increasingly aware of. When an ETF pays out high or frequent distributions, some of that payout often comes from option premiums rather than true capital gains over time that can slowly reduce the fund's net asset value, especially if volatility falls or if markets trend in one direction for too long. In other words, WPAY might provide regular income, but possibly at the cost of gradual price declines. So how are investors reacting? Right now, it's a mix. Some early adopters are thrilled with the weekly cash flow and see WPAY as a convenient, passive way to earn consistent income. They argue that even if the price drifts slightly over time, the steady flow of distributions makes up for it. Others are more cautious, holding WPAY but watching carefully to see how sustainable its payouts are over a longer period. And then there are those who've already sold, worried that weekly frequency doesn't necessarily mean better performance or stability. And that's where the sell or hold debate gets real. If you're considering selling, the main argument is that WPAY is still new, and its long-term performance isn't fully proven yet. You might prefer to lock in gains or move to a more established income ETF with a longer track record. You'd also be avoiding potential volatility or NAV drift that can come from the covered call model. But if you're holding, your mindset is different. You're likely focused on income, not price movement. You understand that covered call funds trade off capital appreciation for consistent distributions, and you're okay with that trade-off. You might even reinvest the payouts through dividend reinvestment, building your position gradually over time while compounding weekly income. Both sides make valid points. Selling can protect you from uncertainty, but holding lets you enjoy consistent income while testing how WPAY performs across different market conditions. Now let's talk about strategy. If you already hold WPAY, one smart move could be to pair it with other ETF that have different payout structures. That creates a staggered income stream where your cash flow is more evenly distributed throughout the month. It's a simple way to smooth out timing differences while diversifying your exposure. Alternatively, if you're on the fence about buying or selling, you could hold a small position and track it over time. See how consistent the payouts are, how the NAV behaves, and how Roundhill continues to manage the fund's holdings. That kind of hands-on observation often provides more clarity than just reacting to short-term market chatter. And if you decide to sell, there's no harm in that. Either the ETF market is constantly evolving, and new income products are emerging almost every month. You can always rotate into something that aligns better with your personal goals or risk tolerance. At the end of the day, the decision to sell or hold WPAY really depends on what kind of investor you are. Neither choice is right or wrong. It all comes down to your goals and how you define success in your portfolio. So, what do you think? Are you holding WPAY for the long haul, or do you think it's time to move on? Drop your thoughts in the comments. I'd love to hear your take. And if you found this breakdown helpful, make sure to like button, subscribe, and turn on notifications for more faceless finance talk here on MoneyStick Unfiltered. We break down trending ETF, new income strategies, and market moves, all without the fluff. Thanks for watching, and I'll catch you in the next one.